Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending June 5th, 2020. And it was a pretty good week for the market, actually, pretty impressive week. So this is the S&P 500 daily chart. That's a 200-day moving average in blue. It recaptured that 200-day last week and held up right along there. So this past week over here, gained 4.9% on the week. And unlike the month of May, it was actually a decent week. It wasn't like the entire month of May, all of the gains, you can go back and see my last video, were made in the overnight session. And then in the cash session, nothing happened or actually gave back some gains. So it was really a suspect market all of the month of May, especially the last 2 weeks. But this week was actually pretty solid. And there were some gains in the overnight session, but those were coming from index futures following global stocks, particularly like Europe. Emerging markets did real well. Here's the MSCI All World Index, excluding the US. Again, this is daily chart, 200-day moving average. So it was up 7.25% on the week. I mean, just look at this week over here. Really strong, outperformed the S&P 500 by 225 basis points. Here's EEM, emerging markets. I mean, look at this week right over here. Again, 200-day moving average rallies up to it. I think they did 8.25% on the week. So again, outperformed the S&P. Stimulus, I think that was from Germany. There was stimulus talk, fiscal stimulus, and then there was the ECB loading up on monetary stimulus on Thursday. So all kinds of stimulus stuff going on. Here's SPY's 3C chart up to Thursday. I'll show you Friday at the end. So this was where kind of tensions flared up with China, and President Trump said he was going to make a statement the next day. And you saw some real strong selling into that. But coming into this week, I mean, solid confirmation. Here's Monday through the rest of the week, solid confirmation towards, Wednesday, Thursday. This is kind of like a consolidation or pullback type signal. It's not a real sharp divergence. And that's pretty much what we had up to that point on Thursday. Here's the Dow Industrial Average outperformed the S&P. So it did 6.8% on the week. This is a 200-day moving average. And notice kind of where it maybe found some kind of resistance around here at that March bear flag right here. On Friday, we have kind of a long tail on this candle. So it closed off the highs of the day, maybe a little bit like a shooting star. From the start of the week, the Dow or the DIA, the diamonds, came into the week with the best 3C chart. And here it is again, like SPY. This is that little area with the kind of China fears coming into the week over here. Really good confirmation. Again, a little bit of a divergence, kind of like a consolidation, which is what we see up to Thursday. But it came into the week with the best 3C chart, and it had the best performance, except for small caps, which did a little bit better. Here's IWM for small caps, daily chart again, 200-day moving average. This is that trend line that I showed last week, going all the way back to 2009. Kind of back testing into it last week. We saw some sellers right there. But anyway, it captured that 200-day moving average above. And again, a little bit of kind of like a shooting star over here on Friday, just above that 200-day moving average. A lot of sectors too, S&B sectors kind of went up to that 200-day moving average. NYSE, same thing. Small caps outperformed 8% on the week. Now, this is what was interesting about the week and why it looked solid. First, that small caps outperformed. They tend to lead the market. But the reason they outperformed was because all the cyclical, like the really economically sensitive growth sectors that are also value, they got beaten up the most on this crash, all rallied. So up until really this last week, kind of the last month, but really the last week, really been the large cap or the mega cap tech stocks, like a half dozen of them that had moved the market. And that's why we had like really bad weak breadth as we got higher. So this week alleviated some of that. We got a lot better participation. And again, it was from those economically sensitive stocks. So whether it was that they were beaten up the most and people were jumping into them, the fear of missing out, what can I buy that's cheap, or whether it's that reopening optimism, either way, that's why small caps outperformed on the week. Here's Nasdaq 100. It made an all-time new record high above the high here in February. But believe it or not, it was the worst performing index on the week. It was the laggard, only up 2.8%, about half of what the S&P was up. This trend line shows the February all-time record high, and it's closed above it, about 1.1% above it. Tried to make it above on Thursday over here. And we watched this. Actually, if you look at the mega caps, the FANGs or the MAGA stocks, they crapped out on Thursday, and Nasdaq had its heaviest volume in 5 years on this down day. So that was something kind of interesting. Here's Nasdaq's total volume, and here's Thursday. So like the highest in 5 years, That means higher than any day, including like quad witching days, which always have like really high volume, and it was on a down day. Here's QQQ's 3C chart. So some of the worst confirmation actually into the week. It did get this nice move here on Friday, so it had good confirmation early in the day, but still you have this relative negative divergence. So here is the new high above that February high. This is the count of the Nasdaq 100 stocks that are making new 52-week highs. So you can see as it was rallying into that February high, more stocks making high highs. So relative to that level, prices are at the same exact spot, 1.1% above. You have far fewer stocks making new 52-week highs with the index. One other thing to point out real quick, this is the S&P up here, and this is the count of new 52-week lows. This is kind of interesting. So on Friday, when it gapped up, it had the third highest number of new 52-week lows in the last 2 months. It was surprising. I didn't expect to see something like that. So here's a daily chart of the Dow. You might remember I pointed out this broadening formation last week, and somewhere right about here, there was that dash for trash rally I was talking about. And the groups that had done really well were stuff that were just beaten up the most, that had really crappy balance sheets, airlines, cruise lines, some retail, stuff like that. That was the stuff that was flying this week. For instance, the airlines had their best week ever. This is the Jets ETF, 33% on the week. Here's American Airlines, 77% on the week. Who's buying these? These are like the top stocks held by people trading on Robinhood. Here's a tweet from Citron Research. Robinhood traders have zero idea what they're buying. He's talking about American Airlines. The balance sheet is upside down. Unencumbered assets are worth far less than the current price. The reason why Buffett fully exited lower, they don't teach finance in the Sherwood Forest. To clarify, previous tweet, the 25K new users on Robinhood who bought the stock at 19 must know more about airlines than Buffett, who sold the stock at 11. Send your resumes to Omaha. Expect the stock to trade back to 10. Here's Hertz. You might remember this one. This little rally right there, that was the strongest leader in all the Russell 2000. That was that dash for trash. This is just to show you how much it's fallen. As soon as it did this rally, a couple days up, huge rally, they went bankrupt. And this is what happened since. So Hertz rallied 157% on the week and 360% off this low. Look where price is, higher than when this stock went bankrupt. This could be an absolutely worthless stock, zero. They claimed bankruptcy. This is one of those stocks that was doing real well this week, that really speculative kind of thing. Who was buying it? Here's the stock price in purple, and this is the number of Robinhood users that hold that stock. A stock that's literally gone bankrupt, that its equity may be worth zero. Look at all these people just piling in. Here's Carnival Cruise Lines up 30%, actually 36% on the week. Carnival Cruise Lines. Once again, Robinhood users, check out the put to call ratio. Very speculative. Everybody just buying calls. Nobody worried about buying downside insurance at all. And this is a chart from Sentiment Trader. If you don't follow him on Twitter, check him out. So this shows the SP 500. Here's the all-time record high. Here's the crash. Here is our recent rebound. And this shows small trader call buys, okay, in millions. So at the record highs in February, before any coronavirus, 7.5 million. This last week, 12.1 million. Speculation run rampant. So there was that aspect of the market this week, was not so solid in my opinion. When I see stuff like that, I want to be selling to these guys. So I did a little bit more of that this week. So probably what got the most attention was the payrolls report. It did help out a lot on Friday. The market was running out of steam. Remember, the Nasdaq 100 was trying to make a new high on Thursday, and those mega cap stocks, it was like they had been mugged or looted. They were nowhere to be found. They were just performing horribly, and it only had to move 0.2% to make that record high. So the payrolls report helped out. Remember, this is where we have that huge volume on that down day. So the employment report came in at 2.5 million job gains for the month of May, okay, and a 13.3% unemployment rate. Consensus was looking for 8 million jobs lost and a 19.7% unemployment rate. So I think the guy who was closest was looking for 800,000 jobs to be lost. He was the closest, and 2.5 million were added. So the market was just deliriously happy on Friday. It made no sense whatsoever, because on Thursday we got initial jobless claims. So another 1.9 million people filed unemployment. And on Friday, we get this huge beat. Even CNBC was like, well, what's going on? So if the jobs are really coming back that strongly, maybe the government, the senators, the Congress people don't feel the same pressure to move forward with additional fiscal stimulus. And in fact, President Trump had a meeting to talk about fiscal stimulus and they canceled it. Let me try to give you some context. Okay, this is from the St. Louis Fed. You can see the years down here, 2002, 4, 2008. The gray area here is recession shading. And this is the total non-farm employee count. So you can see this is how many people lost their jobs in the last 6, 8 weeks, right? So that big job report that everybody's so excited about, the V-shaped recovery, this is it. Might be like a little hard to see, but that is it. So that gives you some context. This is the unemployment rate, 1950, 1960. These are recessions. So this is the unemployment rate, even after that jobs report, even after it came in better than expected. This is the kind of unemployment rate that we had in the Great Depression. But guess what? The whole report was a big error. This was literally attached to the report from the Bureau of Labor Statistics. Okay, I've already highlighted it. I'm going to zoom in. We're going to take a closer look. I'm not going to read the whole thing to you. You can read it if you want. Pause the video and read it. The gist of what this says is that they mistakenly counted 4.9 million people if the workers who were recorded as unemployed but absent for work due to other reasons had been classified correctly as unemployed on temporary layoff. The overall unemployment rate would have been about 3 percentage points higher than reported. However, according to usual practice, the data from the household survey are accepted as recorded to maintain data integrity. That means they did not fix the error. They put a little note at the end of the report right here for anybody who bothered to look. They said they made an error and they said they didn't fix the error. So of the 2.5 million jobs that were added, 4.9 million were counted incorrectly. Some other economists have also pointed out that almost all the job gains would have stemmed from furloughed employees who had basically been kept on the books due to the PPP loans. So did the market give back all those gains? We're looking at the NYSE, by the way, over here, and it's a daily chart. No, it didn't give back all the gains, but it came off the high and it left these kind of, in a lot of areas like shooting stars or doji stars. This looks more like a shooting star in the NYSE, which means prices came off the high of the day. Now, Treasury yields had jumped up huge on this employment report. That was one of the really impressive things that made it look like a really strong week. They gave back a lot too. Here's the 30-year yield. It had been up as high as 14 basis points and retraced most of that. Remember I said I would show you Friday, the 3C chart Friday. So Thursday, Wednesday, Thursday, it looked like a consolidation. Friday, no confirmation. Early in the morning, we didn't make a higher high in 3C. And you can see it kind of leak off. Now, this isn't really horrible, but went from really strong confirmation early in the week to kind of like a consolidation here. Here's the unemployment report, sends the market higher, and then just fades off into the afternoon. Same thing we saw in the bond market. Here's high yield credit. I'm not sure it has a worthwhile signal anymore because the Fed is intervening in these markets. I think they have 4.8 billion of credit ETFs on their balance sheet right now. But the point I want to make was early in the week, Monday, Tuesday, high yield credit was like soaring, really, really strong. Look at Friday over here. It was up big, but 3C really, really plunged Friday. So this was one of the really impressive signs early in the week and one of the really weaker looking signs at the end of the week. Again, after that unemployment report. Each of the averages are different, but the same kind of theme was apparent elsewhere. So here's QQQ making that all-time record high on Friday over here after the employment report. Again, no confirmation and diverging into the end of the week. So it was a strong week. In my opinion, it was an impressive week. One of the more impressive weeks I think that I've seen in really since the rally started. I definitely felt like I was fighting the tape with my shorts, but I have a lot of risk tolerance when I believe in a position, when I have some evidence for why I believe in a position, not just because I'm in it. And I think what we're still doing is that return to normal psychological aspect of a bear market rally. The crash from the new paradigm, the denial phase, and that rally, the return to normal. And psychologically, that's really what's been happening. We're reopening. You can see it here in price. Here's the new paradigm. Here's the crash. Here's that return to normal. Well, what about the Nasdaq? It made an all-time new record high. I pointed this out for my members during the week. It was really interesting. The day I pointed it out, the Nasdaq was 0.2% away from that all-time new record high. Remember, this is that day of huge volume. So what I pointed out was something that happened in 2000. So here's the Nasdaq 100. Here's the year 2000. This is the top over here. So you had about a 35% decline, and then you had about a 35% rally. They returned to normal, right? So the Nasdaq 100 did not make a new high. It made a lower high, a counter trend rally. But the S&P 500, it came down, it rallied, and it came within 0.2% of its record high over here. So almost the exact same amount that we saw Nasdaq on Thursday. That's why it was ironic and I pointed it out. So it's the same situation as we have now, except flip it. Instead of the Nasdaq making the new high or about to make the new high, it was the S&P. So I'm not making the point that, oh, it's going to happen just like this. I'm making the point that there's historical precedence. It's not unusual. As far as the extent of the rally, you got about 43% in 3 months. There was this huge counter trend rally that I've always used as an example, the Dow in 1929, 1930. It had a crash and then it had a counter trend rally. This was almost 50%. It was 47%. So the S&P's done 43% in 3 months. This was 47% in 5 months. And people say, well, the Fed's different this time because of the Fed. The Fed was involved in this bear market rally as well. During the crash, emergency rate cut. Fed injects liquidity into the market, injects liquidity into the market. In today's terms, that was about $2.1 trillion. Fed cuts interest rates by 50 basis points. That started the actual rally. Just like in March, the Fed started the rally to the day. It's not to say it's going to happen the exact same way as it did back then or anything like that. It's to say there's historical precedence. It's not unusual. It feels crazy to watch, but it's not unusual. In last weekend's video, I was pointing out this broadening formation. This is a 60-minute chart, by the way. So you can see April, May, into June over here. Broadening formation, which is higher highs, lower lows. It moves above. We have Fed liquidity in the market. It's definitely moving the market. Moves above this broadening range, right? Did the exact same thing on the daily chart. Broadening formation runs above the top. Why? Because the Fed is injecting liquidity in the third quarter and the fourth quarter of 2019. I think we're going to see a lot more price action like this. Big rallies, big sharp declines, because as the market's rallying on Fed liquidity, the market is not paying attention to or discounting risk. I think the discounting function of equities is just about blown because of the Fed. Never seen broadening formations this big in an index ever, but I suspect we're going to see a lot more of this kind of price activity in the years to come. Let me point out one other thing real quick. Look where the S&P is. So we're right back here to those levels in early January. Here is the big difference. The unemployment rate over here was 3.5%. The unemployment rate over here is 13.3% using the flawed BLS data from Friday. Over here, the market was pricing in 5 to 10% earnings growth for 2020. Over here, we're in a recession. Here was the 24-month forward PE multiple for the S&P at the February all-time record high. Here it is now. That means on a price to earnings basis, stocks are more expensive than they were in February, even though we have 20 some odd million people unemployed and are in a recession. Here's global world stock prices in green. Here's this rally that we're in right now. Look at their consensus 12-month EPS, expected earnings per share, plunging. So over here, even though we're almost at the same level as in January, stocks are now in the top 10% most expensive they've ever been, while the economy is in the bottom 10% worst, or maybe even the bottom 1% worst that it has ever been. It's an incredible mismatch. Again, the unemployment rate over here, 3.5%. Over here, well, it's over 13. We know that for sure. So at the all-time high in February, the unemployment rate was down here at pretty much levels that we saw in price in January. The unemployment rate is up here. Well, maybe it doesn't matter. Here's the Wilshire Index, and here is the non-farm total employees. They have a pretty darn tight correlation over the years, going back to the dot-com bubble over here, the great financial crisis. Here is the number of employees employed, and here's our rally. So, maybe it is different this time. Maybe it doesn't matter. But The reason I analyze markets is to determine probabilities, and this chart alone tells me probabilities say that this is a huge, huge alligator jaw waiting to snap shut. So with that, I think I will wrap up this video. We have the Fed on deck next week. Watching all these protests around the nation, it's hard for me to imagine that we aren't going to see a second wave of COVID cases. I'm not a doctor, but I do know how to read a chart. I live in Florida. This is Florida's new cases. So you can see this is where they're really ramping up. This is a daily chart, and this is a weekly average. The state shut down. You can see the number of new cases fell. This is where the state reopened. Our state reopened right here in early May. Like I said, I'm not a doctor, but I can read a trend, and I don't need the moving average to see that the number of new cases since we reopened is going up. Let's wrap it up here. If you like the video, please give it a thumbs up and don't forget to subscribe. I think there's a subscribe link to YouTube down here for my channel in the bottom right hand corner. Check out the website. I do put up some free content every now and then. You can subscribe for that free content, or you can subscribe and become a member. Don't forget to follow me on Twitter too. Everybody have a fantastic weekend. Please stay safe, and I will see members on Monday. Unless something comes up Sunday night, I'll have an update out then.